Hi, good morning. My name is Brianna Marquis. I'm one of the attorneys at the West Hartford office of Cummings and Lockwood. Thank you so much for inviting me to speak today. I appreciate the opportunity to discuss some of these charitable vehicles with you. Today I'll be discussing a few different types of charitable trusts that work best in different types of interest rate environments, particularly in high interest rates as we are currently. And specifically, we'll be looking at CRATs, CRUTs, and CLATs, and we'll get to what those are, what they mean, and how they work. So after years of low interest rates, we've recently seen a significant rise. This graph here shows about the past 10 years of the November Section 7520 rate. As many of you know, each month the IRS issues a revenue ruling, and it publishes the applicable federal rate, or the AFR, for the coming month. The 7520 rate, which is a section of the Internal Revenue Code, is equal to 120% of the applicable federal midterm rate under the code. And so we use this rate to determine the present value of annuities, life estates, and remainders or reversionary interests. Oftentimes we use it for gift or estate tax planning, so it's an important rate that we really try to keep an eye on. And so in 2019 and 2020, we had some extremely low rates. You can see that at one point it was below 1%. And then just a few years later in 2023, we can see that we were up well over 5%. And so for estate planning purposes, that's a pretty big swing. And as estate planning attorneys, we're always being asked to come up with a strategy that'll produce the best tax outcome for our clients. And I'm sure you as advisors experience some of the same requests. And so while this type of fluctuation does add complexity to our plans, it also provides a lot of new opportunities. For clients who are charitably inclined, there's several ways to make the best use of the current interest rate environment in order to maximize their gifts to charity. Once you've established that the client actually does have charitable intent, you'll need to consider several factors when choosing the most appropriate charitable structure. And obviously, the biggest threshold issue there is to make sure that your clients actually do have that charitable intent and do want to benefit charity. So we get it a lot where they see the tax benefits to these types of plans, but then they may not realize that at the end of the day, when their trust terminates, those assets aren't coming back to their family, they're actually going to charity. So we have to make sure that we're very clear in that type of planning. So for example, you should consider whether the clients have one or more charitable organizations that they want to benefit. Are there particular causes that they like to support? Do they have a specific charity in mind? So a donor should really take the time to consider what types of causes they want to benefit, because sometimes it's difficult, if not impossible, to change the charitable beneficiary. Your clients should also think about whether there's other individuals they want to benefit. So it could be themselves, it could be other family members. So the donor should really consider their income needs and the needs of their family when they're picking the individual beneficiaries to benefit. Another big consideration is what the clients plan to contribute. Are the assets highly appreciated? Do they produce income? We usually see assets like cash, securities, and real estate, but sometimes there are specific rules when dealing with certain types of assets, so it's important for the donor to speak with our advisors to determine what's best for their particular situation. So at the end of the day, if you and your clients decide that a charitable trust is right for them, then one of the biggest decisions is the actual structure of the trust. So with a charitable lead trust, or a CLT, the charity gets its distribution first, and then the remainder passes to individual beneficiaries. With a charitable remainder trust, the individual benefits first, and then the charity gets its share. So there's different tax implications for each, and we'll talk about both of those in more detail. So again, if your clients are going the trust route, another important consideration is the payment type in the trust. So annuity payments are a fixed percentage of the initial value that are paid each year. And on the other hand, unit trust payments are a specified percentage of the trust assets as revalued each year. So that means the amount can change. So this is a good transition to our first charitable structure. But first, I do want to discuss a few general benefits of setting up a charitable trust, basically. So transferring assets to certain kinds of charitable trusts could exclude them from your client's taxable estate upon their death, which obviously reduces their estate tax liability. Contributing highly appreciated assets to a charitable trust allows your client to preserve the value of their assets. They can avoid paying capital gains tax that would otherwise be due if they sold highly appreciated assets outright. When a charitable trust sells those assets, it won't incur capital gains tax liability. And this obviously enables your client to give more to their chosen charitable organizations. If your clients create a CRT, a charitable remainder trust, they can receive an immediate income tax deduction for the amount of the contributed assets that'll eventually go to the charity. CLTs, charitable lead trusts, can also be set up so that the donor receives a charitable deduction in the year that the trust is funded. The most popular structure to use in a high interest rate environment is a charitable remainder annuity trust. So that's that CRAT that we discussed earlier. And to understand why it works so well, I'll start with a brief overview of what CRTs are and how they work. So essentially, contributions are irrevocable transfers designed to allow the donor or someone else to receive a potential income stream for a term of years with a maximum of 20 years, or for the life of one or more non-charitable beneficiaries. And then at the end, one or more charities receive the remainder of the donated assets. The donor is eligible to take a partial tax deduction, which is based on the type of trust, the term of the trust, the projected income payments, and the IRS interest rates that assume a certain rate of growth on trust assets. Depending on how the trust is drafted, the donor or their beneficiaries can receive income either annually, semi-annually, monthly, quarterly, and pursuant to the IRS rules, the annuity has to be at least 5%, but no more than 50% of the trust's assets. So if it's established as an annuity trust, it will distribute a fixed annuity amount each year, and additional contributions are not allowed. If, though, it's established as a unit trust, it'll distribute a fixed percentage based on the balance of the trust assets, which are revalued annually, and additional contributions can be made. Depending on how the CRT is established, the trustee may have the power to change the charitable beneficiary during the lifetime of the trust. So let's look briefly at how they work. So essentially, your client will make a contribution to fund the trust. During the trust term, payments will be made to one or more individual beneficiaries, again, either the fixed annuity amount or a fixed percentage. And then at the end of the trust term, any remaining assets go to the charity. And so there's several benefits that are specific to charitable remainder trusts. There's the potential to take a partial income tax charitable deduction, which we discussed. The trust's investment income is exempt from tax. In these types of situations, the donor might consider contributing low basis assets to the trust so that when it's sold, no income tax is generated to the donor and capital gains are eliminated on the sale of the asset. However, you do have to remember that the income beneficiary will pay income tax on the income stream that they receive. Long-term appreciated assets can be contributed to these types of trusts, and then when the trust sells those assets, it's exempt from tax. And so these are a few of the most common questions that we tend to get when we're talking about charitable remainder trusts. The first is, who can be the beneficiary? So it can be any individual as the lifetime beneficiary as long as the value of the charitable remainder interest in the trust is at least 10% of the value of the assets that are transferred to the trust initially. Any individual, class of individuals, or entity can be the beneficiary for a term of up to 20 years. CRTs that are funded during the donor's life generally benefit the donor or the donor's spouse. And that's kind of in contrast to CRTs that are funded on the donor's death, which obviously benefit other people than the donor. It could be the donor's spouse or perhaps their children. If there's multiple beneficiaries, their interest in the CRT could be either successive interests or joint interests. Another question is, how long can it last? It can last for either the lifetime of a beneficiary, multiple beneficiaries, or for a term of years, provided, however, though, that that term does not exceed 20 years. Can the charitable remainder beneficiary be changed after the CRT is funded? If the grantor is the beneficiary of the CRT, they can retain the right to change the charitable remainder beneficiaries. Can the grantor's private foundation be the charitable remainder beneficiary? That's also a big question that we get. Again, if the grantor is the beneficiary of the CRT, they can name their foundation as the charitable remainder beneficiary without adverse transfer tax consequences. However, though, we do want to point out that this could reduce the benefit of their income tax deduction for funding the CRT. The percentage limitation rules that determine how much of the grantor's adjusted gross income can be offset with a charitable deduction in any year are less favorable for gifts to charitable foundations. So something to consider. If the grantor is not a beneficiary of the CRT and wants to avoid having it included in his or her taxable estate, they should be cautious about naming the foundation as a remainder beneficiary. So certainly something that we can talk through with clients if that's something that they're interested in doing. A big question that we tend to get is, can the grantor make additional contributions to the CRT? And for a unit trust, the answer is yes. A grantor will be entitled to an income tax deduction for the value of the charitable remainder interest in the additional assets contributed and to an increased unit trust payment based on the amount added. However, the grantor cannot make additional contributions to a CRAT. We get a lot of questions about what the costs are in administering a CRT. And so that kind of depends on who you name as your trustee and who handles the investments of the trust assets. There could be trustees' fees or advisory fees, management fees. The trustee has to file an information return for the trust each year, and they have to prepare the Schedule K-1 informing the beneficiary of how to report the unit trust payments for income tax purposes. There aren't usually any kind of court costs or court supervision involved in these types of trusts during the beneficiary's life. Some states, though, like New York, do require a court accounting to be filed after the interests of the non-charitable beneficiaries end. There's also costs involved in establishing the trust, like fees to prepare the trust agreement and the gift tax returns. And finally, I'll discuss what the best property to use to fund a CRT during life and what can be funded at death, what shouldn't be used. Generally, funding a CRT during life with low basis assets that, if sold, would produce a long-term capital gain will produce the greatest benefit to the donor. If the CRT will benefit a private foundation, it's generally preferable to fund the CRT with qualified appreciated stock. So when you're funding a CRT at death, it could be advantageous to use assets that are subject to income tax, like retirement accounts. You should avoid funding CRTs with mortgaged property in which the grantor will continue to own an interest in partnerships that hold debt-financed property or that operate an active trade or business, S-corporation stock, assets that are subject to a binding sales contract, or any kind of agreement or understanding under which the trustees of the CRT would be obligated to sell the property to a third party. So those are some things to certainly stay away from. During the grantor's life, retirement accounts and other assets that would cause the grantor to recognize ordinary income if the grantor transferred them to the trust. Illiquid assets, life insurance policies, options, and tangible personal property might also present issues. So again, important to consult with their advisors to make sure that the assets they're contributing are really the best to use in this particular situation. And here I've included a brief example of a CRT calculation. I won't go over it in detail in the interest of time, but you can see that it's very important to actually run the calculation before committing to a particular trust structure. So there's a lot of factors that go into putting together this type of trust. So we need to know the age of the beneficiary. We need to know what rate is applicable at the time. So lots of factors to consider there. And so, as I mentioned earlier, CRATs work particularly well with high interest rates. The benefit from a higher interest rate comes from the formula for calculating the value of the charitable remainder interest when the trust is formed. This valuation determines the donor's deduction amount. So the deduction equals the value of the donated property less the present value of the annuity interest. With a higher 75/20 rate, the payouts will have lower present value, meaning the value of the annuity is discounted more. So this creates a larger interest passing to the charity. Higher interest rates mean a larger available charitable deduction, and it'll also become easier to meet the 10% threshold. When interest rates were at 1%, it would be difficult, if not impossible, to create a lifetime CRAT for individuals who are under the age of 75. With the current rate at about 5%, much younger individuals can pass the test with lifetime CRATs. So as the IRS interest rate increases over the payout rate in an annuity trust provides the better deduction. And so CRUTs, on the other hand, charitable remainder unit trusts, are largely interest rate neutral. So we talked about what to use in high interest rates. It's also good to know what structures are good no matter what, and what can be used in lower interest rates. We kind of like to refer to these as tools in our toolbox, so that way when the situation arises, you're prepared and you can offer the best solution to your clients. CRUTs, there's several different types of CRUTs. We'll only discuss a few. You may be familiar with the standard CRUT, where the donor receives distributions each year that are a set percentage of the trust assets. That percentage is determined at the start of the trust based on its expected length, and it doesn't change during the trust term, although the payment amount itself might change. There's also what we call the NICRUT, or net income CRUT. So instead of receiving a basic unit trust interest, the NICRUT beneficiaries will receive the lesser of the trust net income or a unit trust payment each year. So because net income is often less than a unitrust interest, and because net income does not include trust corpus, the trust can remain relatively intact and potentially grow more rapidly than if a unitrust interest had to be distributed every year. The third is the NIM-CRUT, which is the net income with makeup. So during the term of the trust, the trustee pays a fixed percentage of the value as revalued annually to the donor and/or other beneficiaries. If the trust earns less income than the predetermined fixed percentage, it'll only distribute what's earned, which helps to ensure principal remains intact at all times. And then in a later year, if the trust earns more than the fixed percentage, it'll make up its earlier shortfall to the extent its earned income exceeds that fixed percentage. And then finally, we have the flip CRUT. So until a triggering or a flip date, payments to the income beneficiaries will comprise net income only. After the flip date, the income beneficiaries will begin receiving straight unitrust payments just as with a standard CRUT. And so moving on to CLATs, which are charitable lead annuity trusts, these really shine when interest rates are low. But in order to understand why, we'll have a really brief discussion of CLATs generally. So CLTs are irrevocable trusts. They're designed to support one or more charities for a period of time, with the remaining assets eventually going to family members or other beneficiaries. They can be funded during life or by will. They operate for a set term, which could be a set number of years, the life of one or more individuals, or a combination of the two, during which payments are made to charities. And then at the end of the term, the remainder is distributed to the individual beneficiary. So it's kind of the reverse of the initial structure we were talking about. They can be grantor or non-grantor trusts, and we will look a little bit closer at how they work. So again, the donor makes a contribution to fund the trust. Payments are distributed to one or more specific charities for a set amount of time. So again, either a fixed annuity amount or a fixed percentage of the trust assets. And then at the end of the trust term, any assets left in the trust are distributed to the non-charitable beneficiary. There's several benefits to using a CLT. If the CLT is structured as a grantor trust, the grantor can take an immediate income tax charitable deduction for the present value of the future payments that'll be made to the charitable beneficiary. But those are subject to certain limitations. As I mentioned earlier, CLATs tend to work better with lower interest rates. So when funding a CLAT, you make a taxable gift equal to the value of the contributed assets less the value of the charitable interests. So the charity's interest is equal to the total payments it'll receive over the trust term, discounted to present value using that 75/20 rate. So if the trust assets outperform the 75/20 rate, then the excess earnings and growth at the end of the trust term pass to the remainder beneficiaries. So thus, the potential gift to the family is larger with a lower 75/20 rate. And so ultimately, CLATs serve to reduce a donor's estate rather than freeze its value, since the donor does not receive any annuity payments. They often reduce gift taxes on shifting assets to family members as well. So that concludes my presentation today on some charitable vehicles to use in different interest rate environments. I hope it at least provided a starting point for the conversations if your clients are interested with implementing any of these charitable options. Thank you.